Hi everyone. My name is Hemant Gangolia. I'm the founder and CEO at Rally. I am excited to host you all today for this exciting webinar, tax tips for 2026. Dinesh, can you keep it? Yeah, first. Okay, so today with me, I'm joined by Dinesh and Deepa, and also Abhishek from Rally. They will be covering a lot in detail, but I'm here to kind of give a quick introduction about Rally and what we do. We started Rally a few months ago, but before starting that, I also founded INRI, which had a special focus on the Indian immigrants around the globe. And when we started taxes under INRI, we saw a huge potential to bring this to everyone, and that gave the birth to Build Rally. And it is very interesting that taxes often are the most overlooked item. They are, in fact, one of your biggest expense as you make income throughout the year. But when it comes to taxes, people often procrastinate or kind of overlook it until the last moment. But it shouldn't be so, especially in the AI era where things are more proactive. I think this should be changed, should be changing. And this is exactly our vision at Rally is to build that operating system enabling clients, CPAs, and any stakeholder that are part of this ecosystem to make it more easy and as well as bring that saving opportunity for individuals. So Rally is building an optimizing year-round taxes. We see that the current solutions that are today, let's say TurboTax, H&R Block, if you have ever used or even might be using a CPA, we think the traditional solutions currently fail the users, and there should be a better alternative here, which could be 10x, especially with technology that is changing at a very rapid pace. At Rally today, we offer tax filing, tax planning. We also offer a dedicated CPA who will be your point of contact throughout the year. And along with that, we are building a AI native platform which will keep you proactive with your taxes as you go. And we are giving away special discount this season, so which is like $100 off, valid for a limited time only. Finish next. Okay. So the agenda for today is quite extensive. We want to cover what changed in taxes in the last year. What does it mean for this year? You would have heard about the big beautiful bill that was passed and what came out of it. A lot many pros and cons which we will be sharing today. Um, One other thing we want to obviously discuss is how salary and equity are taxed. As a salaried professionals, we get W-2, but we do also have RSUs if you are working in tech company. So one thing important to understand is how income in different forms are taxed and what are the ways to look at it from a different lens, particularly to save on it. There is the April 15 deadline which is coming, but there are still things to be done, or you could still do to help save on taxes. And what lies ahead will also be discussed like throughout the year what you could do and with respect to advanced tax planning. So Dinesh and Deepa will cover more in detail. So I'll let Deepa and Dinesh take over from here. Thank you.
Hello. Hi, good morning, everyone. My name is Deepa Atal, and I am a CPA as well as a CA from India. And now without wasting any further time, we'll go on to our topic. So first, we'll see why high earners overpay their taxes. So usually, many people have a question that they do end up paying more taxes, and they assume that they should not get taxed so much. So the simple reason for this is they don't do proper tax planning, and we'll see this in three parts. Like when you get a salary income, so taxes are already withheld before you do any proper planning, and it is a math uh, which is done from the payroll taxes, and it is not a personalized math for everybody. So the second thing, sorry, the second thing, when you get RSUs, there is already a withholding of taxes on the RSUs. But the withholding is not what you actually owe on the taxes. So you end up paying more when you finalize your taxes. The third thing is when you file your taxes, filing is not the same as a tax planning. So filing his taxes is just for the, like, after you earn income, and it is basically what has already happened, that you are reporting to the IRS, and it's not just planning. So if you plan properly and take smarter moves before the year end, then you can save something in your taxes. Now let's go to the next slide. Now we'll see the what are the tax changes which are made from the big beautiful bill which was passed in July 2025. So there is a higher standard deduction for everybody this year. For individuals, for singles, it is now $15,750. For married filing jointly, it is $31,500. And it will keep on increasing from the tax years ahead as per the inflation rate. Now, there is also higher itemized deductions. Salt cap has been increased from $10,000 to $40,000. We will see this in detail in the next slide. There is also a higher child tax credit this year. Earlier, it was $2,000. From 2025, it is $2,200, and it is a permanent increase, and it will keep on increasing as per the inflation. There is one more deduction which has been introduced by the new bill. It is called auto loan interest deduction. So up to $10,000 of interest you can deduct, and it is the below line item. Like, even if you get a standard deduction or itemize your taxes, still you can claim the auto loan interest deduction, and it is applicable only for the new vehicles which are purchased and which are US made specially. And there is some more criteria like the weight of the vehicle and all other things, and the income limits of the person who is claiming the interest deduction. Now let's move on to the next slide. So let's see what is SALT deduction. So SALT is nothing but state and local tax deduction. So even if you pay 15 or 20,000 is a state taxes, still before 2025 it was only $10,000 you could have claimed. But from 2025 to 2029 tax years, now you can claim up to $40,000. However, the phase out starts when your income starts rising and it is above 500K. So you have to plan it properly to see if you qualify for higher itemized deductions versus higher standard deductions. Can you go to a next slide now? Now, what changes in 2026 as per the new big beautiful bill? So there is a good news for the people who don't itemize their taxes. Charitable deduction they can claim now. For singles, it is $1,000. For married filing jointly, it is $2,000. For cash donations paid to a qualified charities, and for people who itemize their taxes, there's a new introduction in the charitable deductions. Now, now it is a 0.5% AGI floor has been introduced for the people who itemize their taxes and who also donate in the charity. For example, if you have an AGI of 100K, and if you have donated $1,000, then you can only be able to deduct up to $500. So it's little bit not that great news for people who itemize and do charity. But let's see the other deductions. So there is one more deduction, uh, which is called private mortgage insurance deduction. It is an additional deduction in addition to the mortgage interest, which is deducted from the taxes. There is also a higher dependent care benefits from year 2026. Earlier it was $5,000 and now it is up to $7,500. So people who get the dependent care benefits from their employer, and it is also pre-tax money which can be used for the children's daycare expenses, any other classes, activities, everything. Now let's go to the next slide, please. Now we'll see what is still you can do for the tax year 2025, even if the calendar year has been passed before April 15, 2026. So first you can invest in the HSA. So people who have high deductible plans and they have not maxed out their HSA limit, they have still time to max out their HSA limits and they can contribute it. One more thing, HSA is not necessary to be used only for the medical expenses. When you retire, you can use it as an IRA item. So you can use it for anything, for travel, any other purpose also. If you have money and it still grows in when you retire. Then one more thing, if you haven't done any traditional IRA contributions, you can make it up to April 15, 2026. It depends on the eligibility. You will have to check with your tax advisor if you are eligible for that or not. Then for people who are self-employed and who have a small businesses, they can put their money in solo 401k, SEP IRAs, simple IRAs before April 15th or before due date of the taxes. Let's go to now I'll hand over to the my colleague Dinesh for the advanced tax strategies.
Thanks, Deepa, and thanks, Hemant. So, thanks everyone for taking the time for joining the webinar today, although it's a long weekend. So me, Deepa, and Abhishek, and a couple of other CPAs and enrolled agents have been in this tax practice since last 10 years. Some of us, people like Abhishek, are more than 15, 20 years. And we always come across people asking, how do we save money on taxes? And especially in the Bay Area, it's a very famous concept of taxes where most of the people in the Bay Area are ending up paying anywhere between 30 to 50% in taxes. If you're making around $500,000, both joint dual income, you are paying almost federal tax rate of 37%, and in California or in New York or in any tax heavy states, you're paying anywhere between 8 to 15% in state taxes. In fact, California has mental health tax, or you have net investment tax credit. So almost 50% of your income that you're making is going into taxes. So that's how it became a very famous topic, that how do I save money on taxes? And me, Abhishek, and Deepa here in the call, when we always discuss, if you want to save money on taxes, you need to start thinking about how your income is being taxed, what sources of income that you are receiving. Because on ordinary income or on short term capital gains, which is treated as your ordinary income tax rate, you don't have much option to save, or you have to strive hard, do different things to save money on taxes. But if you're receiving passive income, or if you're receiving long-term capital gains income, or you're receiving business income, then you have more options and more leverage to save money on taxes. As most of you are making money and trying to save money in the form of investments in real estate or in equities, again, that would start generating you income in the form of interest income, dividend income, investment income. It's very, very important for you to understand what all things that you could do short term, what all things that you could do long term, and also how you're making your income. Because if you have RSUs, the tax rate is separate. Uh, and if you have long-term capital gains or qualified dividends or ordinary dividends, the tax treatment would be different. So understanding how your income is being taxed is very, very important to actually thinking about saving money on taxes. And some of the smart strategies that we have come across after dealing with thousands of clients is, you can go beyond what's discussed until now. Usually, retirement planning is something that we always strive to think about when it comes to tax planning. But you could also think about coordinating your equity sales. If you are somebody, a non-executive working in any big tech company which issues you RSUs, most of you are restricted from selling during a blackout period. And you can apply for 10B51 form and basically get the restriction off from your brokerage account, so you are able to sell during blackout period also. In case you are an executive, you don't have an option, but most of the executives working in big tech have an option to defer their compensation. So you're able to defer compensation to years where your tax rate is lower. So in a year, let's assume that you're switching jobs or you're taking a career break. Those years, your effective tax rate might be 20% or 25%. Comparatively to a prime year, let's assume most of the Amazonians have their stock vesting in their fourth year cliff. And in the fourth year, your salary suddenly doubles. In 2024, it might be 250K. In 2025, it's suddenly 500K because all your stocks got vested. And if you have an option to defer compensation to the following year where the stocks are not being vested, then your tax rate would automatically go down and you save significantly on taxes. So, in terms of RSUs or any big tech employees, something that's smart is either using an option to sell during the blackout period or deferring your compensation. And when it comes to tax advantaged accounts, also amongst the immigrants, we see a lot of people mentioning that, hey, I'm not interested in Roth. 401k is giving an immediate upfront tax deduction, but Roth doesn't give. And we might go back to our home country and it's not beneficial in terms of tax treaty. But you'll also have to consider that every year, every place in the world, especially in democratic countries, the taxes are being increased every year. So it's always important to think from a long-term angle when it comes to retirement plans such as Roth or HSA is actually, as Deepa mentioned, is a triple tax advantaged account where you don't get taxed now, where you don't get taxed on the investment growth, and in the end, after your retirement, you are able to take out the money tax free. So, tax advantaged accounts, maxing out all the accounts every year. In case you are not qualified to do a Roth, then you can take an extra effort to do a backdoor Roth. And in any year, your household income is less, then you can explore mega backdoor Roth also. And aiming for long-term capital gains is also helpful. And if you are doing a long-term capital gains, then the tax rate is significantly lower than your effective tax rate in any year if your income is very high. So these are a couple of smart offsetting strategies where you don't need to invest or take risk or explore bigger options to save taxes by being little smart about utilizing compensation deferment or coordinating your equity sales or maxing your tax advantaged accounts or aiming for long-term capital gains. But if you want to save more, imagine you are ending up paying more than $100,000 in taxes or ending up paying more than $200,000 in taxes. In a scenario like that, you would want to think about what all advanced tax strategy options are available. So last year at INRA and Rally, we helped customers to invest in renewable energy projects. And renewable energy investing has started becoming very famous since 2022 when Biden government launched Inflation Reduction Act. Until then, renewable energy investing has had tax credits, but they're not able to transfer the tax credits to any individual investor. For example, the developer is doing a $1 million solar or any renewable energy project. He's getting tax credits for the entire project value, but they're unable to transfer that credit to anybody. So developers are getting exhausted with those credits and the investment stalled. During that time, the Biden government in the Inflation Reduction Act told that, hey, you can transfer the credits to individual investors. So any investor like you and me is interested to get tax credits through solar projects or through renewable energy projects, the developer is able to transfer the tax credit. Suddenly, the entire tax credit marketplace took off in 23 and 24, and 25 saw a huge momentum where you can, as an investor, can invest $100,000 into minimum of 75 to $100,000 into any renewable energy investing project, and you can get $150,000 to $200,000 in tax credit. So, for example, for every dollar you invest, you are getting back 1.3 to $1.5 back in the form of tax credits. So, it didn't make any, it's a very clear logic and it's very advantageous. So, people are taking advantage of solar tax credits or renewable energy tax credits. And there are three different types of renewable energy projects. One is solar projects directly. There's also EV storage, EV charging station projects also. So these are the variety of projects that are available, and cash flows and returns change depending upon the each project. And Rally is build partnerships to help you not just suggest that, hey, solar energy investing is useful, but also help you implement help you connect with the developer, and also file your tax returns in the end to get the tax credits. The only caveat in solar energy investing to offset against your active income, which is your W-2 income, is that you have to qualify as an active solar energy or renewable energy investor. And to qualify as an active investor, you have to spend minimum of 100 hours in a given year, like doing due diligence of renewable energy projects, talking to developers, talking to accountants and tax experts at Rally. All these activities count towards your active material participation. And if you are more interested in saving taxes, like at a layer of 50,000 or 100,000, then you should be thinking about solar energy investing. Some of you might have questions that the Trump government might remove, or what would be a scenario in a scenario like that. EV projects are getting over in 2026, but solar is still applicable until 2027, and developers are accumulating the projects so that they don't need to complete the project by 27, they just need to initiate the project by 27. So we are assuming and we are seeing that the projects will keep continuing in 29, 30, and if the new government comes or any changes happen, this would keep going, and it's approved by top accounting firms in the US. We closely work with CBIZ to file your tax forms and ensure that you're getting the tax credits and also being protected in a scenario of audit. So this is totally a legit strategy. It's not something there is a scam or anything involved here, and we'd be happy to walk you through the entire model, what are the risks involved, and how the numbers work in detail on a one-on-one call. And the second strategy that we saw interest in the big tech circles is charitable reminder trusts. If you have any appreciated stock, let's for an example, you have been working in big tech like since last 10 years or 5 years, worked in Microsoft, then moved to Netflix, then moved to Google. You have accumulated bunch of stock in the form of RSUs which you have never sold, and now the stock gains are more than $500,000. So now if you sell the $500,000 worth of capital gains, then you're easily spending around $100,000 to $150,000 in taxes. So you have only $400,000 left to reinvest back into the market. Whereas in charitable reminder trust, you could move the entire portfolio into a trust and then sell within the trust so you don't have any tax. So you are able to reinvest into the market the entire portfolio versus paying 100,000 to $150,000 in taxes and then reinvesting. The only caveat in charitable reminder trust is you will not have access to the entire liquidity. You will be only be able to take distributions every year, usually 10% of the trust value or some fixed amount, and you pay taxes on the distributions. But the remainder of the assets that are inside the trust, you can keep reinvesting them to different forms of investment, and you can keep selling, and it's totally tax free. Usually, for a charitable reminder trust, the lock in period is high. It's a irrevocable trust. In case anything happens to you, then the trust assets get moved to your beneficiaries, can be your spouse, kids, or parents. And you don't have access to the distribution, and it's high long term, 20 years. In a scenario like that, if you don't want to lock in yourself for 20 years, then the another fund that we have seen which is gaining a lot of traction is exchange funds. So in exchange funds, the lock-in period is for around 7 years. And how exchange fund works is exactly same like charitable reminder trust, but here you are locking it only for 7 years. And for example, you have 100,000 worth of Meta stock, and if you sell it, you might be paying 20% to 40% in taxes depending upon short term and which state you are. So you have only $60,000 left to reinvest into the market, whereas in exchange funds, you are able to invest the entire $100,000 into market where you are diversifying against your Meta stocks. So your exchange fund can be into S&P or any real estate portfolio, and you're diversifying your stock. And there is also other funds like if you are not doing RSUs and you have stock portfolio, instead of investing in S&P, you can invest in yield products where you get better tax loss harvesting. So we'd be happy to go in detail about charitable reminder trusts or solar energy investing or exchange funds or yield products on a one-on-one consultation with Rally team. So these are a bunch of advanced tax strategies which involves learning and also investment or some form of risk taking in case you're looking to save more on taxes. But in case you're not looking to take that much of a risk, you can still be thinking about selling during blackout period or deferring your compensation or maxing your tax advantaged accounts or aiming for long-term capital gains. And who actually should think about tax planning? I don't need to answer. Most of you know whether you have to think about tax planning or not. But generally, we come across people, whoever is making more than $200,000, have RSUs or have or willing to have multiple sources of income streams or wanting to build a long-term wealth, which is tax optimized. And at Rally, we want to provide you an year-round tax advisory service. As a background, Hemant himself worked in Meta and McKinsey, and I have been in the tax world since last 8 years and 6+ years in the Bay Area, seeing everyone coming during the during the filing season and trying to file their taxes and then thinking that, hey, what can I do to save my money on taxes? So taxes is an year-round advisory service if you are looking to save money. So at Rally, we want to help you plan your taxes through the year and file taxes before April 15th. You could use a $100 off to start working with us and looking to save money on taxes. Back to Hemant.
Thank you, Dinesh. Thank you, Deepa. Lovely presentation, and I think a lot of insights as well. Personally, as Dinesh mentioned, I've been at Meta before, and I can relate to the challenges when, as your income starts getting higher, as well as more complexities on a personal side. If you have kids and so on, or trying to get into other private investments or maybe even real estate, slowly or gradually this will become a mess, and taxes especially could be a place where you would be leaking your capital. So as the slide says, is they are a system. Once you know how to kind of manage and use it, you could take it to your advantage. So we'll open the floor for Q&A. So feel free to ask any questions on topics that we discussed, as well as any that you have in mind. You could use this time as an office hour and ask any questions. Yeah. So we already have one question. Dinesh, you want to take it forward from there? From
Yeah,
Anil.
yeah. Yes, Anil. Exchange fund involves the generally we have partners to do exchange funds, and we can do a one-on-one. But yes, you can do. Generally, you are able to exchange your stock with different funds, and the funds are created by financial advisors, which has exposure to S&P or which has exposure to real estate or which has exposure to metals, as you mentioned, and that's how you diversify talking to them.
Thank you.
Any other questions from anyone? Batra ji, Abhishek or Deepa, do you guys want to add, cover anything? Hemant?
Just one question on Dinesh on the RSU, right? So RSU get taxed when they are vested, right? So this is like after the vesting is done, right?
Yes.
Exchange.
Yeah.
So we cannot avoid that, like before the vesting or like after vesting, whatever they deduct, that we cannot we can minimize that one, right? We can set the tax rate to certain threshold to minimize the tax that is going when it's vesting.
Yes, and also you can, if you're estimating your tax liability and all, you can change with your brokerage how much
Okay.
tax they need to withhold. So
Okay.
that is in your control, and you also have an option to not let them sell your stock and pay for taxes if you don't want to do that. And in case you're doing other strategies and you're already decreasing your liability significantly, then you have an option to not let them sell your stock and pay any tax. And you also have an option if you want them to withhold more, then they'll sell more of your stock and pay more tax.
Okay. 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 I'll connect you offline
Yes,
because yeah. Yeah. Thank
sure.
you.
Thank you.
Yeah.
Yeah.
Hey, hi, this is Rohan. Thanks a lot for the insight. Super helpful.
Thanks, Rohan.
I had one question. For any of these tax strategies, does it matter if you're like, does it change based on your like visa status or green card status?
Yes, for exchange funds or for charitable reminder trust, you don't have any issue. But for solar energy investing or real estate, you would require to qualify as an active investor. And to qualify as an active investor, you could do it through an LLC. And again, it depends upon your visa situation, whether you are qualified to open an LLC and be an active member of the LLC.
Got it. Thank you.
Yeah.
Dinesh, I just want to clarify and add one thing on behalf of everybody. So, as Anil has just discussed regarding the exchange funds and all those, in case of RSUs, there are two taxable events. One is a taxable event when the RSUs gets vested in you. When the company gives you the RSUs, that is part of your W-2. After the vesting, when you sell those RSUs, either converting them into equities or you do whatever it in any form, that is another taxable event. So you have to plan in both the situations, both at the time of vesting and both at the time of conversion or sale, whatever you plan. Exchange funds come into play when the vesting has happened. So if you have not vested, the RSUs are not vested in you with you, then you can only defer it so that if permissible by your employer, if it is deferred, then you can plan the taxes. One thing is very clear that when we talk about planning of taxes, lot of compliance is involved. And once the compliance is done, the planning is automatically taken care of because planning is a long process. You cannot plan it for a year. What decision which you take today, like if you decide to move into exchange funds today, then you are getting locked for 7 years. You cannot move out of 7 years. So planning is always a long process. It's not a 1 year process or a 2 year process. You have to do it throughout the year, and it is a commitment for a longer period of time. Like in case of charitable reminder trust, you are committing your funds for a longer period of time. At the end of the year, you're going to get 1/10 of your total funds. So you have to always take care of all those things and the compliances attached to with that. So that's something which you should also take care when planning for your exchange funds or charitable reminder tasks and all those things.
Okay. Rutvik has a question on the chat.
Yeah. So, Ritik, if your health insurance is a high deductible health plan, then yes, you are eligible to qualify and contribute to an HSA investing account. If you have a low deductible health plan, then you're not qualified. And your contributions limits are, if you're doing single, then it's 4,300, and if you're doing joint, it's 8,500. 8,550. Yeah. So,
Um,
yeah, go ahead, Hemant.
yeah, thank you for answering. So, meanwhile, as we get more questions, Dinesh, you want to kind of give a high level overview of a case study that we did recently with some customers? We could profile them and kind of talk how we are helping customers.
Yeah. So, like we are working with a variety of customers, mostly who are in big tech or who are in startups. So, one of our customer is used to work as a founding engineer at a startup, and he moved on to another job, but his startup got acquired by another big tech player, and he have significant capital gains of $2 million in long term, and he has $700,000 in capital gains in short term. And his W2 income is $1.1 million dollars. And overall, the total income for the year came up to around $4 million, on which he's paying $2 million in taxes, around 1.5 to $2 million. And the customer tried to work with different tax planning agencies, which require them to pay like $10,000 to $30,000 for just doing initial tax planning, and came to Rally. And at Rally, we helped the customer to identify the best possible strategies that we could identify, and also try to understand other strategies recommended by other tax planning agencies to the customer. And we investigated all the strategies and finally implemented solar energy investing strategy, where he invested $300,000 into an EV charging station, and is getting a return of around 200%, which is $600,000 back. And $350,000 is in the form of tax credit. So he invested 300K. He already got 350K in tax credit, and he's going to get another half of another 250K to 300K in the form of cash flow over the next 10 years. This is one customer who saved straight $300,000 in taxes using Rally.
Great. Yeah, I think as I understand, there are possibilities where, especially if you're in a high income bracket, opportunities to save a lot on taxes, particularly with these advanced strategies. They definitely lock you in for some time, but given the income that you have, I think it is, makes sense to do that, and think of it from a long term perspective.
Yeah, and another strategy which you guys can think is child Roth IRA. In case you have kids, then you would be able to contribute to the kids if if they are more than 8 years and old, and uh, you want to contribute to their Roth account when they're young, so that by the time they touch 60, that's a big gift that you would be able to give. And child Roth IRA is becoming very famous. So that's one more strategy that is considered to be trending these days. Abhishek, Deepa, do you guys want to add anything that is important for this year in terms of 26? Anil, exchange funds are applicable mostly for RSUs because that's where you're having significant gains, and that's the concentrated position that you have. Exchange funds are focused mostly on people having concentrated portfolio.
Yeah, thanks, Dinesh. I think I was trying to understand that, like, if I have something in my individual account which is like grown like 2000%, right? And I want to defer that one
Yeah, for
to.
that you could think about charitable reminder trust,
Oh,
or
okay,
yeah,
got it.
we can have
Yeah,
a one-on-one session, identify what
okay,
positions are we looking at, and then
got
identify
it.
the right structure.
Okay, yeah, thanks.
I would like to add a strategy for S corp owners and Schedule C business owners. So, if they have children above 18 years of age, they can put them on a payroll, and they can deduct such kind of like employee expenses for these children. Yeah, that's a good strategy, and it is very safe also. Yeah.
Thanks, Deepa. Yeah, paying their kids, and also Augusta rule also, right? Like
Yes.
utilizing their office expenses. Yes.
Yeah.
Abhishek, anything from an India standpoint?
Nothing. One thing is there that we often ignore if we are having some incomes in India, we often ignore those incomes and the expenses related to those income because the taxation system in India is entirely different to what we have in US. So, like supposedly, if you are having a house back in India and you have rented that house, in India, 70% of your rental income is taxed, but that is not the case in US. The whatever the expense you have incurred for running that rental income may be maintenance, property tax, whatever it may be, and any kind of major repair or something like that, or you have appointed some agent for collection of that rent, all those are allowable expenses, and you may end up having a deduction more than 30% of your rent, or it can be less than that also. So you have to make sure that you claim all eligible expenses. The idea behind any claiming any deduction or expense is that it should be related to an income, especially when it is not a employment income. You basically segregate all your incomes into two heads. One, I always say it's into two heads, though legally per se there are four or five heads: employment, rental, business, dividend, and other income, and capital gains. But per se there are two heads: employment income and other than employment income. For employment income, there are specified deductions. You cannot go beyond them. But for all any other kind of income other than employment income, any expense which you have incurred to earn that income is an allowable expense. Like you have incurred any expense for collection of the rent, or you have there was an issue with the tenant, or you had to file a case with them and court with them, and those expenses are not allowable in India. But yes, they are allowable in US. There you can claim those expenses. Similarly, if you have any dividend income in India and you have appointed some agent to manage all those accounts in India, so whatever you're paying for that is also an allowable expense against your dividend income. So you should make sure what all expenses you are incurring and claim an eligible deduction from them.
Thanks, Abhishek.
By the way, quick insert. There is an upcoming webinar that we are doing 2 weeks from now, which will be specifically covering US India tax compliance. Abhishek will be chairing that and will share even more insights on it. I'm gonna put that event link here, so feel free to register and as well as share with your friends who should know about this. Thank you. Sailesh asked a question on recommendation of platforms like Fidelity or Schwab as a 360 tool to manage different investments.
It basically is a personal choice in terms of features. Everybody offers the same. In terms of specific products, if you're looking at CRTs, I don't think Fidelity and Schwab are pretty extensive. There are more newer platforms in terms of CRTs. But for Roth and 360 degree financial planning, yes, it depends upon yeah, Fidelity and Schwab both do a great job. And Shailesh will share a couple of recommendations in our newsletter also about the new platforms that are upcoming into the market. Yeah. And we are also offering tax filing, $100 off on tax filing. So, in case you haven't signed up, go to rally.tax and you can start signing up. And we are building features that basically there's a human expert and also an AI platform, as Hemant mentioned, which will help you not just file your taxes, but also plan your taxes through the year. And thank you all for taking the time to join. Hemant, you want to share? Hemant, Deepa, and Batra.
Yeah, yeah. We are here for any questions, but I think we're just covering anything that might be of interest. Um, and as Dinesh said, right now is the season for filing, so we are getting already getting into it. We have started with 50 odd customers to begin with, and 100 more to join very soon. So the best way to I think look at this season is to get started early. I understand a lot of us might be waiting for documents starting with W2 and then 1099s. But it's good to begin a consultation or getting to know your tax expert sooner so that you are prepared and planning to file before April 15 and not trying to chase the deadline. In case you are looking to do extension, we also help with that. But planning it for throughout the year could be helpful if you begin early.
Even I would like to add here that as per as the latest information from IRS, starting 26th January, we will be able to start filing the returns electronically for the clients. And it's always better to file as early as possible. The sooner you file, the get earlier you're going to get the refunds. So and we can start as early as January 26th, as per the latest information from IRS.
And I would also like to add something like people who haven't paid any estimated taxes on like January 15th, they can file taxes by February 2nd, 2026 and avoid any penalties for the tax year 2025.
Yeah, good point. So we do also help estimate taxes. So as part of planning, we are not just offering these products, but anything that makes you save on it, including penalties or avoiding penalties. So we did estimates for tens of customers recently, and if you are expecting a tax liability or a tax bill this year, would be good to estimate the taxes before and avoid any penalty. I can share about a friend who ended up paying $3,000 in penalties last year because they had a large capital gain, and it's much easier to avoid that. And we helped him this year to pay an estimated amount so that he could avoid a penalty. So, yeah, tax saving is, could be in multiple forms. Essentially, saving your capital could be in multiple forms. And having a team like Rally, I think, would be super useful year on year to save on taxes on a long-term basis. And one more thing to add, when we talked about businesses, so we are an end-to-end full service platform. So if you want to incorporate business, we do that as well. So we just don't take care of taxes, but whatever it comes in terms of implementation, including incorporation and compliance, we help do that too.
You just rightly mentioned about the estimation of taxes. It's very generally what we have when we work, we are employed, we have a belief that all our taxes are taken care by our employer. But anybody who's having capital gains income would certainly have income beyond employment income and tax payable on that capital gains beyond the employment income. As per the law, you have to pay the taxes as you earn the tax income. So if your income is beyond a certain threshold and you have a capital gain, it's always advisable to get your estimation done in advance. And if any tax is payable, even if you don't file the return, it's better to pay the tax at the earliest so that the penalties and interest can be waived off. And you can always claim that you had the intention to pay it, because penalties are always where there is a intention to evade the tax. When you have yourself voluntarily got their estimation done for the taxes and paid that voluntarily, then we can prove it to the IRS that it was always the intention. Due to the non-availability of all other documentation which is required for filing the returns, the return got delayed. So it's always better to get that estimation done, especially when you have capital gains income.
Dinesh, we have some time. Do you want to kind of do a quick demo, maybe of the tax plan tool? I think this would be useful.
Give me a second.
So, quick background. So we talked about tax saving opportunities. What we have created is a as an interesting tool and a very powerful one to discover them in 60 seconds. If you upload your 1040 or even put an estimate on your based on your income and profile, we help you discover what tax saving opportunities could be applicable. Some of them may not be eligible and depends, and that's where that one-on consultation would be helpful. But on a high level, you could see what are the strategies that you could potentially use and save thousands of dollars on taxes. So we'll be doing a quick demonstration of it and sharing the link as well, which you could do it yourself. You could also download a PDF and keep it for yourself, share with a friend or your network. So I posted the link for the tool and we'll be doing the demo shortly.
One second, Hemant. I'm just trying to find a doc to upload.
You could just use the calculator. It should be fine. Yeah, just
Okay. You see my screen?
yes.
So you could basically get a free tax plan. Either you could upload a 1040 of your own of your original tax return, or you could simply fill in some details about your situation. If you're about your uh, if you have a business, or if you have stocks, or if you have RSUs and real estate, and then we automatically generate a free tax plan. This is generic, but you can get a customized one by uploading your 1040, which would say if you are eligible for solar tax credits, or if you have a business, then it talks about qualified small business stock option, or charitable reminder trust, or qualified opportunity funds, or using real estate, or itemizing your tax return, or using an Augusta rule, or in case you want to optimize your cash flow every month from your paycheck, then optimizing your taxes according optimizing your cash flow, and optimizing your pay stub. And in case you have dividend income, then moving the dividend income from your regular brokerage to tax optimized accounts like Roth, and tax loss harvesting. Instead of investing in products like S&P 500, you can invest in individual stocks using products like FREC or even Charles Schwab offers, where you are able to take advantage of tax loss harvesting. And in case you have carry forward losses, the algorithm is able to recognize the losses and help you take carry forward losses for the next years. So these are a couple of strategies that it automatically posts and says which one are you eligible for and which one you're not eligible. And once you log into the Rally account, you're able to add these strategies, and your CPA is able to help you implement these strategies, and you have visibility and transparency about which all ones you are wanting to implement this year versus which all ones you would want to implement for the following years. Hope this is useful, Hemant.
Yeah, definitely. I think uh, there are a few tools which are available, but I think they fall short of implementation. We offer that end to end, which I think is more valuable. You could possibly get this also from ChatGPT, but I think the place where it will fail is not, making sure it is accurate. ChatGPT is a good horizontal solution. You can ask questions, even put in your documents, but when it comes to reliability, it's hard to take an action on it. And this is where going to a CPA or actually a human expert will be more actionable. And this is where Rally combines the best of both worlds. We are offering CPAs as well as AI solutions, which will work hand in hand to give you the best outcome, as well as the peace of mind. Okay. So I'll also share the link for the $100 off. We'll be sharing in the email as well. So this offer is through in partnership with INRI that we have been offering, and I'm guessing like most of you would know. So you could click that link and click the claim $100 benefit link and start from there. And one thing to also share is a lot of people ask about pricing. So our pricing is in tune with respect to the complexity. we do not intend to um, over overcharge or anything. The pricing is based on the value that we are offering or the outcome that you see. So in no way it should be any higher that you are saving less and then you're paying more. We are working in your best interest, and as a fiduciary, making sure that you are saving on the promise that we offer. And in case it doesn't, so the pricing would be accommodating that. And one thing I think we probably didn't mention is you could also refer friends. So I'm sure like taxes are a topic that we often discuss in a network, especially during the season. So you could get additional 50 credits and offer that 50 to your friends as well. So you can shore up as many credits and do unlimited referrals. So once you sign up, you should be able to see your link as well and can refer other friends too. And these credits essentially could be used for your next payment. So making it even free if you get 10 friends, I would say. Yeah. Okay. Yeah, so we are almost at the end. We still have 20 people. So thank you for staying till the end. I hope everyone had at least some takeaway today, and are ready to look at the season and get started. We are happy to help. You could also email us at hello@rally.tax. Um, and we are happy to help in any case or do a one-on-one consultation. Our consultations, initial consultations are free, so there is no upfront cost to it. You can start booking today, your first exploratory call, and we'll help align your objectives as well as our processes together. Dinesh, anything to add before?
We covered it all.
Okay.
Thank you, everyone.
Yeah. Thank you.
Thank
Have a
you.
good weekend.
Thank you, everyone.
Yeah.
Thank
Look
you.
forward
Bye.
to working.
Bye. Thanks,
Okay.
Deepa. Thanks,
Thank
Abhishek.
you. Thank
Thank
you.
Thank
you.
you.
Bye.
Thank you, everyone.